Hey, it's Joshua here with another edition of Mortgage Clarity. And we're going to, in this episode, cover USDA Loans 101. Kind of some basics on what the USDA program is and how it compares to other programs and who it might be great for. So, USDA is a special program. It's one of my favorite, but it has a lot of little quirks to it that you kind of got to know, and it can make it limiting for some borrowers. So, things I like about USDA is it's a zero down program. So if you're not a veteran and eligible for the VA home loan, then USDA is the next best thing for somebody who's trying to get into a home and not have to put a down payment down. So that's a great plus. Another thing I like about USDA is when we compare it to some other programs like the FHA, which might be the next closest comparison to it, would be that FHA has a mortgage insurance multiplier of 0.85% if you're putting down less than 5%. What that means is whatever your loan amount is, you times that by 0.85%, divide that by 12, and that's how you get to your monthly mortgage insurance cost. Now with FHA, not only are you putting zero down, but that mortgage insurance multiplier is 0.35. So significantly less cost for the mortgage insurance. Also, when comparing to FHA, FHA has that upfront FHA mortgage funding fee of 1.75% of the loan amount. And with USDA, that's only 1%. So there's another good savings there. So again, apples to apples, even if FHA might have, say, an eighth of a percent lower rate, because you're not having to pay that 0.75 additional fee compared to USDA, and your mortgage insurance is more than half, USDA wins. So what are some of the limiting factors with USDA, and how does this work? So I do want to note that USDA, while it's common for first-time home buyers, you do not have to be an exclusive first-time home buyer. But one big difference with USDA versus other programs is that you cannot own more than one property, the subject property. Now, there are some exceptions to that based on family household size. If you happen to own, maybe let's just say a 2-bed, 1-bath, and there's now 7 people in the family, FHA would, or USDA would come back and say, okay, that's not a suitable living for that situation. But it's very difficult to get those exceptions. So for now, we'll just say basically you can't own any other property at the time of closing. You can be selling a home, and as long as that home sells on or before the day you close on the new loan, then you can go with USDA. Now, another problem with USDA is it does have geographical limitations. So based on where you're at here in the United States, if the town in which you're wanting to purchase exceeds a certain population density, then USDA will not lend in that area. It was originally developed as a rural, kind of a rural loan, and so it really doesn't want to be in larger cities. Now, to find out whether or not where you're looking works, you can Google USDA eligibility maps or something like that. You can find USDA's website, and they actually have a cool little tool where you can either put in the city and it'll tell you if it's in or out, or actually drop in the property address you're looking at, and it will tell you if it's inside or outside an eligible area. Now, some other unique things with USDA is, unlike the other programs, it has 2 ways of looking at income, and this is really important. So from a standpoint of qualifying for the mortgage, it's pretty much like other programs where it looks at your income over the last year, what the wages are, grossing up income that's not taxable like Social Security and stuff, and just does the normal type of calculation to determine what the max payment you can take on for the home. So it uses a more conservative calculation. But USDA actually has a max income limit to even be eligible for the program. And this again varies on whether or not the household is 1 to 4 persons, 5 to 8, or over 8, and what area you're in, because different counties throughout the United States will have different income limits. We won't go over that in this video. But if your income, as you calculate it, which when they do that, they will use the most aggressive income calculation. So they'll look at what your income was last year, what your income is year to date, and what it is this month. So if you just recently got a raise and they take that raise and forecast going forward what that would mean for income, if it makes too much money now, even 1 penny over, you're excluded from the program. However, on the flip side, same scenario, let's just say you didn't quite go over, so you still qualify. They will now go back and use the lower the income you've earned to qualify for that payment. So you have to kind of watch out for that with USDA. Also with USDA, when it comes to homes like manufactured homes, they don't lend on manufactured homes in all areas of the US. There are certain areas like here in Oregon, where I'm from, where they will lend on manufactured homes, but they have different age requirements than their standard requirements on manufactured homes for the other programs. So that's something to look out for as well. Last but not least, what makes USDA maybe a little bit more difficult for some other borrowers is it has tighter debt to income ratio requirements than other programs. So again, if we stick with comparing this to FHA, if you've watched my other video on FHA Lending 101, FHA quite frequently will go as high as 55% debt ratio and will allow the house payment to be as high as maybe like 44%, 45%. All these things varies on individual applications and everything's being looked at, but as a general rule, USDA, it doesn't usually like to see that house payment go more than 32%. And sometimes when the program decides to make themselves more restrictive, which in all these programs, they have the ability to behind the scene make their automated software more restrictive. At times, USDA wouldn't accept more than 29% of your income for your house payment. And it likes to see your total debt ratio, so that's the house payment plus the debt on your consumer debt, not to exceed 45%. So it's much more limited there. Now, some of that limiting factor gets offset by that lower mortgage insurance cost, but it's definitely something to consider. Actually, I said that was last but not least, but there's one more thing I want to talk about, which I mentioned as well on the FHA loan, is when it comes to things like significant derogatory credit. So have you had a foreclosure? Have you had a bankruptcy? These types of things. USDA, like FHA, is more lenient than conventional programs. And so you'll have a shorter waiting period on that. If you have any more questions about USDA, whether or not it would work for you and what that might look like, feel free to reach out to me directly. You should see a link to my website or my email address down below. Be more than happy to take the conversation offline and have a fantastic day. If you like this video, please hit the like button. That helps other people. If you haven't subscribed and you like the content, subscribe. That way you can be alerted to any future updates that we do throughout the year. All right, have a great day.